Come here, they sang, renowned Odysseus, and listen to our two voices. That's the song of the Sirens from Homer's Odyssey, the voices that lured sailors in toward the rocks. Markets, of course, have their own sirens, and lately there's been no shortage of them. And by the way, just past the Sirens, Odysseus had to thread a narrow strait between Scylla and Charybdis, monster on one side and a whirlpool on the other. Today I'm joined again by portfolio manager Paul Moroz, and we use that stretch of Odysseus's long journey to talk through the seductive side of things, like memory, a wave of giant IPOs, and the AI complex more broadly, and then the harder question waiting right behind it. When there's no safe option, no safe course to chart, how do you decide which risk to live with? My conversation with Paul up next. Well, Paul, welcome back to the podcast.
Thanks for having me, Rob.
You've been on a little bit recently, and you have a habit, I think, or you and I have a habit of going back in time. Remember earlier this year, we went back to Shakespeare and literature and gleaning lessons that can be applied to investing. We're going to go back a little bit further, albeit still in the realm of literature today, back to Homer and the Odyssey, with some investing lessons that you think are particularly relevant today. And so wondering if you can set the stage for us.
Okay, so the Odyssey was written by Homer. It was Greek poems. It might have been 800 BCE in terms of the time period. And it really told the story of the protagonist, Odysseus, him getting home after the Trojan Wars. And there's a couple stories that were really fascinating. I think most people would remember this. There's a story of the Sirens and the seductive calls that would lead to him crashing his ship into the rocks. And then there is another story, or the next challenge on the voyage. And by the way, he was tipped off on both of these, but there was a whirlpool called Charybdis. It was a monster creating this whirlpool. And if he got too close to that, it would take him down. But on the other side, if he steered too far away from Charybdis, he would get too close to these rocks and cliffs and a sea monster named Scylla. Odysseus wasn't the strongest character. He's not Achilles. But Homer painted him as a character that exemplified wisdom and patience and resilience. And that's the setup. And I think these stories have some wisdom for us today.
Well, let's go back to the Sirens. Let's start with that one and the story of this beautiful song that would lure sailors in. I can imagine there are some beautiful songs in markets today. Of course, Odysseus, as you mentioned, knew what was coming and had a strategy for it. And so can you describe what that was and just, paint it back to, there are a variety of siren songs out there that I can imagine, but, maybe just what's loudest to you right now?
Most stocks in up markets or down markets become serial correlated. And one of the biggest themes, and it's a theme that we own in the portfolio, is memory stocks. So this was historically a commodity type of business. The demand has gone through the roof for memory semiconductors, partly because a lot of the DRAM, or sort of stacked DRAM, which is called HBM or high bandwidth memory, goes into data centers. And everyone has become an expert on this. And this is just, we are drastically short this input. And there's a bottleneck even in the supply chain. There's a company called ASML, which produces the machines to enable this process. And they're short. So everything is short and backed up. And so you have volumes increasing rapidly. You have price increases like never before. Just, was it this morning or overnight? Apple had announced that they're increasing the price by 15 or 20%. And that's because of memory prices. Even Apple, with the bargaining power they have. There are fundamental reasons why this is going up. That's kind of the wisdom in the Sirens songs. And things have gone up so rapidly that you're seeing retail investors pile on. You're seeing ETFs with leverage be created. And that's all fine, but you need to have a logic behind those investment decisions. The risk of ignorance is that you say just because a stock is going up, that it might not be more valuable. And you have to go through your investment process and valuation and look at upside versus downside. And certainly, this is an area where we spend extensive time modeling, right? We just had an update overnight from our team in Singapore. I was on the phone a few days ago with one of our analysts going through the model again because the price changes are so dynamic. We want to understand upside and downside and probabilities, knowing too that this is still going to be cyclical, right? SK Hynix trades at a little more than 5 times earnings, 6 times earnings, depending whose earnings estimates you believe. So it's not valuation risk from a P of the price to earnings ratio, of the PE ratio. It's more about the cyclicality of the E. And that's the question mark. Will this super cycle go on for a couple years, for 3 years, for 5 years? How much price deflation will there be? So those are some of the questions we're wrestling with. But let's just bring it back to our reference to the Odyssey and what Odysseus had concluded that he was going to do is he wanted to balance the risk of seduction with the risk of ignorance. And he got his crew to tie him to the mast of the ship. And they had beeswax in their ears so they could guide the ship through. So he still heard what they were saying and took that information in without being seduced. So many of these things are balanced, but I just thought that that's a really interesting tale. So, what's our equivalent of that? I mean, to give viewers a sense, we participated, for example, in SK Hynix, we allocated 164 basis points or 1.64% of the value of the portfolio into SK Hynix over time. We have now sold 159 basis points or 1.59% of the cost base of it. It's still over a 5% position, but systematically we're peeling that back. And this is over, Rob, this is just over the course of a year.
Yeah, under a year even. Yeah.
Right. And we're managing risk by cutting our position, but also when I'm telling viewers, it's a little bit of it could be perceived as behavioral finance, focusing on your cost base. But, back to actively looking at the models, what's the new odds, the prices, how is the market evolving with some of the long-term contracts that they're signing with customers? How will that influence the industry? And really establishing our fair value range so that we can allocate capital properly, right? It's a matter of odds with these things. Going back to that process and that discipline of risk management, I think that's one of the things that we're doing that relates to the story.
Yeah, and I thought you had an important clarification with respect to the story of the Sirens, which was, he was tipped off in advance. So he had time to think about, okay, if this were to happen, what am I going to do in advance? And so it's not about making those decisions in the moment. It's about having a plan, being open, and there's something to the Siren song. Don't be completely blind to it, but have a process to make sure that you stay disciplined. Can I ask though, just this concept of, hey, you've taken out almost as much as you've put into a position, and it's still a fairly large weight in the portfolio at about 5%. Does that make you think about the position differently? Meaning, if it's something that you earn and the position is exactly what you put in, do you think about it differently from a portfolio management context versus, hey, I didn't put in much. In fact, I took out almost as much as I put in, and I still have this kind of free weight in the portfolio?
That's the risk of that. That would be, back to the risk of mental accounting, and that you're somehow not looking at the market value of that. Going back to the models, that's what really keeps you in check, because at any point we can invest in something else. We can cut the position. We can reallocate to another security. But the truth is that there are definitely some themes and arguments for why the security could be worth more, including a normalization of valuation of South Korean stocks compared to some similar type of securities in the US, including a shortage that is set to intensify, including the theme of agentic AI. And imagine you're going to need more CPUs and more memory. If you can envision a world where there's just more agentic machines running processes, we might be very early in this thing. So we're trying to balance all those odds. Same thing in the past, we've looked at, the original thesis, Rob, was some very rudimentary analysis in terms of like, what's our real downside? In the past, this is a stock that has traded down to 1 times book value. And so, as a process check, that's something that we've looked at as it accrues book value, what could be downside based on historical metrics or trading patterns. So all those are a consideration into the decision. It's not just a mental accounting exercise. It's thinking about odds and probabilities and twisting that math in different ways.
We're going to have Shannon, our colleague in Singapore, in a couple of weeks on the podcast to really do a deep dive in memory. And so can I ask you about another siren song that I perceive in the market? And that is just these mega IPOs that seem to be lined up. Of course, we had SpaceX and potentially some others in the near future. Have you thought about those with respect to what they mean for markets? Perhaps even the individual investment cases themselves, but how they enter into our process.
These are incredible because they are marking a period of investment history where new business models are being developed, capital markets are evolving. They're huge. They're so significant. They all have high elements of risk that are attached to them, whether it's SpaceX, whether it's these frontier models that we're still uncertain of who's going to win or how the industry will evolve. And I think that there's still a great amount of debate on how the value in the value chain will actually be captured between models and those providing the compute and those with unique distribution advantages. And of course, investment bankers are really good for finding a spot in the market and taking advantage, I think, of the animal spirits that capitalist investors have. I think one thing that's a bigger picture idea of note is just that we're going through a period of time where it seems like the economy's gone a lot more capital intensive. And I think it's a question mark of, well, if you're bringing something big to market, there can be a risk. These companies are so big, they can get fast-tracked, I think, to indexes and benchmarks pretty quickly. But I think that the capital has to come from somewhere. What are you selling? The hyperscalers, SpaceX, certainly, I mean, they're going to the bond market as well. So I think we went through a period of time where business models were asset light. They could grow their business without requiring much capital. People were buying back stock. And it's interesting, there's a lot of people that kind of charge these companies for not reinvesting in the business and just buying back stock. And now we're going through a period of time where there are investment opportunities, but the capital intensity of these businesses are increasing. Now, do these new IPOs, are they so big they start to crowd things out? I don't know. Maybe. Sort of an interesting tension, Rob, because we're in a business where everyone looks at performance and thinks to themselves, okay, well, if a stock goes up, that's a good thing. Well, if the multiple expands, it does impact your reinvestment risk if you want to invest more in the stock market. And what we've been seeing lately, and maybe it's the crowding out, but like companies have been growing earnings, and there's some stocks that really have not expanded their price to earnings multiples. If anything, it's been more deflationary. And so you might be a little bit sad when you look at your statement, but it's an interesting setup because your reinvestment risk actually improves. There's nothing saying that we can't go through a period of time, and it could be 5 or 10 years, where multiples, because of the capital intensity of the economy, because you're not buying back stock, you're investing in new projects, your price to earnings multiples and valuation grinds down, which makes you sad when you look at your statement, but really happy if you're doing the math and recognizing you can actually reinvest at a better rate of return. You'll actually compound money over 10 or 15 or 20 years better.
This would be sort of akin to in a commodity business. Actually, the time to invest is when the multiple is higher.
Yeah, it's a similar analogy. Yeah.
Yeah. Okay. Interesting. Can I ask about the other side, though, that you mentioned the cost of capital? In a world that's more capital intensive, I assume that implies that your cost of capital matters that much more. And I know you have a few thoughts with respect to these big IPOs and just what a cost of capital advantage might look like.
If we take SpaceX and Elon Musk as an example, I mean, he's someone that thinks from first principles. And I think most people are aware he was trying to fast track SpaceX to get into the index, the S&P 500. And why not? Because you have a cost of capital advantage. And I think the truth is the cost of capital advantage has probably evolved so that if you're in a certain index, you just have a lower cost of capital versus if you're not, if you're a smaller company, you have a higher cost.
Or even if you're in a particular jurisdiction, like the US, you might have a lower cost of capital. Yeah.
Same thing. It's like it's not a continuous thing. It's actually not related to the actual riskiness of the investment. It's just a structural advantage or disadvantage in your cost of capital. And it relates to, you could call it from an industry perspective, a distribution advantage. If you run a publicly traded company and you're in the S&P 500, you have a low cost distribution advantage to shareholders investing in the stock. And if you were a small cap company in Greece, maybe a Troy company or maybe a company in the island of Ithaca, just as your cost of capital is going to be higher. That's just the way the world works.
Can we return to the Odyssey? There's another story that I think rhymes with a lot of what we've been talking about. And that is the choice that Odysseus had at one point between choosing between two bad options. I wonder if you can describe that story for us.
Yeah. So then the next, after they passed through the Sirens adventure, then they were faced, and again, I think he was tipped off on this one too.
I think he knew what he was getting into.
Yeah. There was Charybdis I always have Charybdis on the right-hand side. I actually don't know if it's on the right-hand or left-hand side, but Charybdis is, I think, ultimately a monster underneath, but something that creates a giant whirlpool. And that would have just taken the entire ship down. But then on the other side, and again, I have this on my left side. I don't know if that's correct. On the left side, let's just say, is the monster Scylla, which was a 6-headed sea monster that lived in the cliffs and would basically eat the people on your boat. You can imagine being a sea monster, you're all alone, not a lot of ships pass through. So when a boat comes through, it's lunchtime. This is such a good example because there's so many times in life where the choices that you make, it's not a clear answer. It's not a perfect answer. There's trade-offs.
And there's no way to eliminate risk.
There's no way to eliminate risk.
It's about which risk that you're willing to choose. I can imagine a big one for clients, and imagine you as a portfolio manager today is, okay, AI, this theme we've been talking about. I mean, it's such a big chunk of what's driving economic growth today. It's such a big chunk of what's driving corporate earnings overall. As we know, it's been such a big chunk of what's been driving the stock market overall. We started talking about memory, and of course, that's just one piece of this bigger AI trade. And I would think that a big question from a portfolio management perspective is, okay, on my left, I've got the risk of concentration, and on the right, the risk of just not keeping up when everything has been driven by this particular theme. And curious how you're thinking about that right now.
This is retelling the tale in a different way from, I think we did a podcast together back almost a year ago, right when I stepped back in, and we talked about, well, here, telling everyone, here's what I'm going to do. I'm going to stand in the middle of the net. I'm going to balance these risks. And it's probably even more two-dimensional than that, because you have valuation risk, right? But then that can often be offset with disruption risk, right? It's not so clear that just the cheapest thing from a value perspective on paper is actually less risky. You also have cyclicality risk. So that's back to memory stocks, the difference, but the P, price to earnings ratio, the P and the E, it's not a P issue, it's the cyclicality of the E. Let's go back to our protagonist, Odysseus, for a moment, because what he chose to do is stay in the middle of the net and sort of lean a little bit closer to Scylla. And he was concerned about the ship being sucked into the whirlpool, Charybdis, and losing everything. The choice that he made, though, in going closer to Scylla was Scylla picked off 6 of his men. It was a 6-headed monster. That makes sense, right? So that was probably not a very fun choice for him, but it was the lesser of 2 evils. So what are we doing? We're participating in AI, but we're also constructing a portfolio in a manner where we're going to survive no matter what. But it does mean that, yeah, we haven't been keeping up. If this continues, we won't be keeping up. I just sold a security that I redid the math on it after a 25% move. I won't name the security right now, but it was a complete exit because of valuation. So these things aren't clear. There's trade-offs. And the other thing is, like, we were not going to get all of these right. There's just no way. You want to stay balanced with different names. But that's kind of the way that we're charting the ship. And I think back to the message of staying in the middle of the net, if you like that analogy, great. We're being consistent and saying, listen, we're doing the same thing. Charybdis on the right, Scylla on the left. We're going to, just like Odysseus, we're going to lean a little bit to Scylla. And that's how we're navigating this difficult situation. There is a trade-off.
On AI specifically, Paul, can you put some numbers around it? Like how are you judging your? It's not as simple as like, hey, there's this country that this, and even that's not simple, I guess. But how are you sort of quantifying some of that risk when thinking about the portfolio?
Very simply. And so now we're going from stock selection to portfolio construction, which I think is very important for people. Our AI exposure, which is actual hardware, picks and shovels, chips, stuff like that, is 22.7% of the portfolio. And this is all as of basically today. And so I think that, in a scenario, just imagine, like, for some reason, this is rolling over and half of that is gone, just like that. That's an 11, 12% drawdown, just for perspective. There's exposure, we're participating, but I think in a downside scenario, it's not a complete disaster.
So it's significant, but you're saying it's manageable. It's something a portfolio can recover from.
Exactly. Now, the other thing too is there's an offset, because we have about 15.5% of the portfolio that are in my opinion, very high quality businesses, but have been funding that CapEx. So these are companies like Meta or Microsoft or Amazon. They all have different front end business models, but they're all acquiring compute, and really the ones that are funding this. Now that you could look at the offset, the correlation, and say, wait a minute, one person's CapEx is another person's revenue. So if something falls on this side, right, there's going to be a natural offset or a natural contradiction. So one way to look at it would say, well, actually, Paul, what you're trying to do is balance that risk off. And so your net CapEx exposure, right, it's not 22%, it's 7 or 8 points of that's actually leaning towards AI and that collection of it. And we have seen that in the market. There's certainly days where that correlation will fluctuate. But fundamentally, as a long-term business person, there's going to be some relationship between those that are collecting money and providing the CapEx services and those spending the CapEx. Now, if you lump all that together and say, the market will still put that into an AI basket, then it's a little more than a third of the portfolio that you could look at it being tied to AI, even though I think that's a little bit extreme. But then there's all the rest of the portfolio that's in different things, whether it's oil or gold or cement companies or distribution companies or things that are completely different.
But it's still amazing how some of those things that are completely different are kind of been sucked into the whirlpool, right? I know we, not in the global portfolio, but I know we have an investment in our emerging markets portfolio, for example, that services ship engines. And you wouldn't have thought of this as like an AI business. But of course, what ship engines do is provide reliable power for long periods of time to vessels at sea. And so, they're now powering data centers. And this company is going to service those as well. And so it's almost like the whirlpool is expanding. Do you feel that?
A little bit, and it'll ebb and flow. We're at the point now where we're participating, and there's spots where you can kind of arbitrage out places that might actually have less risk. Another example of that same fact, something that we wrestle with, is utility companies. So particularly power utilities. And we have a few percentage points of exposure in the portfolio. And again, they could sometimes they act very defensive, right? Because they're going to be around. And sometimes they act like they're more of an AI stock, again, because of that short power, that they'll have this reinvestment opportunity. So it depends on the day. But my point is that, we get the opportunity to see different patterns. The market isn't perfect. The market's very efficient, but not perfectly efficient. And often you can arbitrage things out based on the risk. It may not have the same feature that you're talking about related to AI. And that's when you can trade something off for something else.
Paul, there's one more story from the Odyssey that I want to get your reaction to. And this has to do with the Cyclops. Odysseus defeats the Cyclops, and this goes back to your comment that Odysseus wasn't the strongest guy, but he was sharp, he was witty, he was cunning, and I can't remember specifically, but he sort of he tricks the Cyclops into not knowing who had actually defeated him. But on the way out, Odysseus couldn't help but sort of brag and shout back, it was me, it was Odysseus who got you. Which caused the Cyclops to complain to the gods, I think Poseidon in this case, and Poseidon then messed with Odysseus for like the next 10 years and just made his his voyage miserable. I think it's a story in humility about getting things right and then still recognizing that lots of different dangers could lurk ahead. How are you thinking about that right now, both with decisions that you're getting right and maybe decisions that you're getting wrong, that on the opposite side, you don't want to beat yourself up too much about either?
The longer you're in this business, you just realize you see everything. And often things are never as bad as you think they are. And when things are good, they're not as good as you think they are. And the cure, quite honestly, is diversification. And that's, going back to what I said before, right away in this investment regime, what we were going to do is we're going to have more names where we're just short of 90 now in the portfolio. I said before, it could get to as high as 100. And the positions are going to be often smaller. And viewers probably don't know this, but I'm moving in smaller bits and pieces quite often, recognizing there's just so much volatility in the market that you might not get the exact price that you want. It might move against you. And so I think all those concepts are really imply the humility that we're taking at a process level to put the portfolio together with portfolio construction. That's how I would relate that. that concept. It was funny, just as a story, we invested, added to one of our positions the other day, and one of the analysts gave me a compliment right away and said, "Paul, nice trade." And I shot back to him right away. I'm like, maybe, we'll see. It's an odds-based thing.
And I think that's kind of the crazy thing about investing, right? Is Odysseus eventually did get home. There was an end eventually. There's no end for us. We're managing money for generations in some cases, and that requires a different type of mindset. Anyway, Paul, thank you so much for taking the time for another meandering conversation. Always love chatting with you. Thank you.
Thanks, Rob.